Oh, hi. Welcome to our weekly apartment update. A lot of investors are concerned about all the new development activity about to take place. Developers plan to open close to 9,000 units a year over the next 3 years in our region. That's up significantly from the last 10 years when development activity averaged just 3,200 units a year. And that has a lot of investors nervous about the market. But really, you've got to look at development as really just one ingredient in a recipe. And so let's take a look at all of these ingredients. First step is to step back and let's look at this development activity coming up and compare it to trends in the past. Certainly if we go back 10 or 12 years, it's still a record level of development. In the late 1990s, developers opened about 6,000 units a year in that boom for a couple of years. You've got to go back 20 years plus to see more development activity. In the late 1980s, developers opened about 12,000 units a year. Now, the 1980s was a different world than we're in today. In the 1980s, we had a tremendous amount of job growth. Between 1988 and 1990, our economy grew by over 200,000 jobs. Conway-Peterson Economics is forecasting that between 2013 and 2015, our economy will grow by about 137,000 jobs. Also, in the 1980s, we had a lot of housing demand that was fueled by the baby boom population. But one thing to think about when you look at all this apartment development activity is you have to put it in perspective of total housing development. And in the last couple of years, we've seen a major shift away from for sale housing to rental housing development. Single family and condominium development activity has basically fallen off the map in the last few years. Single family development is starting to pick up, and certainly condominium development activity will pick up at some point in the future, but it still means that there has been a shift towards more rental development than for sale development in the last number of years. As a result, when you look at total housing development activity, what's happening in the next 3 years is still a lower level of development than we saw in the late 1990s or even the late 1980s. The other factor I mentioned was the baby boom population. The baby boom population grew into their 20s very rapidly in the 1970s on into the early 1980s. And that fueled a lot of housing demand all through the 1980s. In the 1990s, the baby boomers sort of moved on, and we had a lot of Gen X move into their 20s. But the Gen X population group nationwide was about half the size of the baby boom population. That means we had very little addition to the 20-somethings in our marketplace during the 1990s. We still had housing demand, but it was at a lower level than during the 1980s. Now, in the last few years, we've seen a significant increase in the number of 20-somethings in our region. That's being fueled by Gen Y moving into their 20s, and that's continuing through 2014, and that will have, or should have, a significant impact on housing demand for the next number of years. And so if you look at these trends, you can just see how flat things were in the 1990s, and yet how things have picked up again in the last few years. The next thing to look at is what we call the geyser effect, the number of people turning 65 each year. Over the last few decades, we've seen on average in our region about 20,000 people a year turn 65. Over the next few years, that number is more than doubling to about 45,000 people a year. This is really the result of the baby boomers getting older and moving into retirement age. And the reason this matters for the apartment market is that although most of these 65-year-olds are probably homeowners, not renters, a lot of them have jobs, and a lot of them are going to be retiring from jobs. So over the next few years, we anticipate that basically twice as many people are going to be retiring than we've seen in the past, simply because of this age group being so large. That's going to create more opportunities for 20-somethings to move into the job market. So when you piece this all together, we are looking at a significant amount of apartment development taking place between 2013 and 2015, but it's not an all-time record. we're not seeing or anticipating as much job growth as we saw in the late 1980s, but we're still anticipating significant job growth and more job growth than we saw in the late 1990s, although that's offset by more production as well. However, when it comes to the demographic side of things, we're seeing a lot more 20-somethings now than we saw in the late 90s. Not as many as the late 80s, but very significant. And we're seeing the brand new phenomena of the geyser effect. So we're not saying that vacancies aren't going to go up. In fact, they are. And more than that, not only are vacancies going to go up, but our December issue of the Apartment Advisor forecast vacancies would trend higher pretty steadily from now through early to mid-2015. In addition to that, rent growth will slow very significantly over the next couple of years, basically stop growing by early 2015. And on top of that, we anticipate a lot more rent concessions creeping into the market, which, when you combine all of these factors, will reduce net operating income pretty significantly over the next couple of years. But just over the next couple of years, these are temporary blips. And again, when you look at all the factors in this, basically in this recipe, you can see that although the market's not going to be in total balance over the next year or 2 years, it's not really that much out of whack compared to what we've seen in the past. We hope that you've enjoyed this weekly update, and you'll come back again next week.